Dividends are the profits that companies distribute to their shareholders. They can choose to reinvest the profits, acquire other companies, or reward their shareholders by paying out dividends. Having a dividend portfolio can be beneficial because it provides consistent payouts for your stocks, which is especially attractive in the current market environment. We'll go over the dividend rates. Important statistics. Let's start with the first stock, Home Depot. Home Depot is a well-known store in the US, and besides being a good dividend stock, it has also provided investors with returns of 88% over the past 5 years. Currently trading at $291.17, its stock price has had its ups and downs over the past year, reaching a low of $270 and highs of $325 and $330. Home Depot pays a dividend yield of 2.67%, which is higher than the sector average. This means that for each share you own, you'll receive a quarterly dividend of 2.9 cents. Their payout ratio, which shows the percentage of profit paid out as dividends, is 46.68, indicating a healthy dividend growth for the past 14 years. With a market cap of $192 billion, Home Depot is a large and well-established company. Analysts rate Home Depot as a buy, with an average price target of $327, higher than the current price. Although dividend income is a plus, I also consider the long-term prospects of a company. Home Depot excels in the home improvement sector and has a dominant position, outpacing its main competitor, Lowe's. They cater to professional contractors and have a better outlook for fiscal year 2023 compared to Lowe's. Home Depot's dividend yield of 2.7% has shown consistent growth. It is a reliable company to invest in, with quarterly dividend payments providing extra cash. Next up is Procter Gamble. Currently trading at around $150 per share, the stock has shown some fluctuations over the past year, reaching a high of over $160 and a low of around $123. Procter & Gamble offers a dividend yield of 2.42%, meaning that for each share you own, you'll receive 91 cents in dividend payments every quarter. The payout ratio, which indicates the portion of profits paid out as dividends, is 64.07%, slightly higher but still reasonable. With a market cap of $360 billion, Procter & Gamble is a large and established company. Analysts rate it as a buy with an average price target of $155, slightly higher than the current price. One notable aspect of Procter & Gamble is its operating margin of 21.61%, which is significantly better than its competitor, Kimberly-Clark. In fiscal year 2022, Procter & Gamble generated $14 billion in revenue, showing growth compared to the previous year. They experienced a 5% boost in organic sales and were able to offset a decrease in sales volume by increasing their prices by 10%. Looking ahead, Procter & Gamble has a growth forecast of 4 to 5% for 2023. Although the dividend yield may not be extremely high, Procter & Gamble is a stable and reliable company with a long-term outlook. It offers the potential for price appreciation and the added bonus of consistent dividend payments, making it a great choice for investors. Next up is Altria. Currently priced at $44.50 per share, the stock has experienced some ups and downs in the past year, starting at $55 and dropping to the 40s before stabilizing. What makes Altria interesting is its high dividend yield of 8.35%, which is much higher than the average for its sector. This means that for every share of Altria stock you own, you'll receive a quarterly dividend payment of 94 cents. However, it's important to note that the payout ratio, which indicates the proportion of profits allocated to dividends, is relatively high at 76.78%. This makes it a riskier investment compared to others we've discussed. Nevertheless, Altria has demonstrated consistent dividend growth over the years, making it a tempting choice for income-focused investors. Analysts currently rate Altria as a hold, with an average price target of $49.63, suggesting some potential upside. While Altria is a tobacco company, it's worth considering from a business and investment standpoint. The tobacco industry is undergoing a transition due to declining smoking rates, which have dropped by about 40% in the past 2 decades. Altria is adapting to this shift by investing in smokeless products, such as e-cigarettes like Juul. With strong cash reserves and strategic acquisitions, Altria is positioning itself well for the changing landscape. Although Altria has faced challenges, including the ill-fated acquisition of Juul in 2018, it remains an attractive investment option. The high dividend yield compensates for any potential risks. However, it's important to consider that Treasury bills are currently paying close to 5% interest, so the decision to invest in Altria ultimately depends on your risk tolerance. Next up is Bank of America, one of the largest banks in the US with 67 million customers and small business clients. I know some people are skeptical about investing in bank stocks, especially given recent events with companies like SVB, and there are even those who swear off banking stocks altogether, like Kevin O'Leary. However, I believe the concerns may be a bit exaggerated, particularly when it comes to Bank of America. Currently, one share of Bank of America is priced at $27.94. If we look at the one-year price chart, we can see that it was trading around $40 per share a year ago. It has had its ups and downs, and the price has experienced a significant decrease, which explains why it's now in the high $20s range. In terms of dividends, Bank of America offers a yield of 3.1%, which is higher than the sector average. This means that for each share of Bank of America stock you own, you'll receive a quarterly dividend payment of 22 cents. The payout ratio, which measures the proportion of profits distributed as dividends, is a healthy 27.15%. Analysts currently rate Bank of America as a 2.4, which is between a buy and a hold. The average price target for the stock is around $37, indicating a potential upside of about 30% compared to the current price. The next earnings date is April 18th, and they are expected to report a year-over-year decline of 5% in earnings per share. While it may not be the most exciting stock to own, it offers a decent dividend payment for a banking stock. Next up is PepsiCo. Currently, one share of PepsiCo is priced at $183.20. If we look at the one-year price chart, it has experienced ups and downs, like most stocks. About a year ago, it was in the low $170s, dropped to the $150s, then went up and down until reaching its current price. PepsiCo offers a dividend yield of 2.51%. This means that for each share of the stock you own, you'll receive $1.15 in dividend payments every quarter. The payout ratio, which indicates the proportion of profits paid out as dividends, is 67.69%, which is slightly high. However, if you look at the dividend growth, it has been quite good. Analysts currently rate PepsiCo as a 2.5, which is between a buy and a hold. The average analyst price target is $191.13, representing a potential increase of under 5% from the current price. PepsiCo recently unveiled a new logo, the first one since 2008, which has generated a lot of buzz for the company. It has performed well, with a 9.3% increase over the past year, marking the 18th consecutive quarter of positive revenue. PepsiCo also recently announced a $260 million partnership with 3 major farmer-facing organizations, supporting over 3 million acres of U.S. farmland. This initiative strengthens their food system resilience, which is crucial to their overall business. All right, next up is the Schwab US Dividend Equity, ETF. Now, this is not an individual company but an ETF, which stands for Exchange Traded Fund. If you're familiar with my content, you know I'm a big advocate of index funds and ETFs. They allow you to invest in a diverse range of companies with just one investment. SCHD focuses on high dividend-paying companies. When you buy this stock, you're essentially purchasing a basket of dividend-paying stocks. Currently, one share of SCHD is priced at $73.23. Looking at the one-year price chart, it has experienced some ups and downs. It was around $80 a year ago, then dropped, had a rally at the end of 2022, and has been on a gradual upward trend since then. The dividend yield for SCHD is a pretty good 3.61%. It also has an average price-to-earnings ratio of 13.89, which is favorable. In terms of the fund overview, SCHD is a large value fund managed by Schwab, with net assets of over $46 billion. The ETF has a focus on sectors such as consumer cyclical, financial services, consumer defense, healthcare, energy, industrials, and technology. These sectors make up a significant portion of the portfolio. One of the top reasons investors love SCHD is its low expense ratio of 0.06%. Although it's not as low as some Vanguard ETFs, it's still quite good for a dividend-focused ETF. SCHD aims to track the Dow Jones Dividend 100 Index, which prioritizes consistent and sustainable dividend generation. This ETF is perfect for a buy-and-hold strategy. It's designed to provide steady dividend income over time. It's considered one of the best dividend ETFs in the market. Other options like VYM are also great choices. Passive management is crucial for dividend-focused ETFs because it helps keep fees low. SCHD is a safe investment that you can consistently contribute to, collecting reliable dividend payments while focusing on generating additional income. In summary, SCHD is a reliable and an exciting ETF that you should consider adding to your portfolio. Its focus on dividend-paying stocks and low expense ratio make it an attractive choice for long-term investors. With SCHD, you can save on fees, earn consistent dividends, and have more time to focus on other income-generating opportunities. Let's talk about Realty Income Corporation. It's a REIT, which stands for Real Estate Investment Trust. Essentially, it's a company that owns income-generating real estate assets. Right now, one share of Realty Income is priced at $62.65. Looking at the price chart over the past year, you can see some ups and downs. It started around $70, had a drop, went back up, saw a decline at the end of 2022, and has been fluctuating since then. The current dividend yield is 4.75%. This means that for each share you own, you'll receive 25 cents every month. It's important to note that the payout ratio is above 100, indicating that the dividends paid out by the REIT are higher than the projected income from future operations. In the short term, they are using cash reserves to cover the difference, which is okay. However, it's not ideal for the long term. Analysts rate Realty Income as a 2.4, meaning it's between a buy and a hold. The average price target from analysts is around $70.50, which is about 15% higher than the current price. Realty Income stands out as one of the better REITs in the market. They have a portfolio of over 12,000 real estate properties leased under long-term agreements and have been in operation for 54 years. Recently, they announced their 633rd consecutive monthly dividend payment, which is impressive. While many people are concerned about real estate due to high interest rates and a potential housing bubble, I believe the fear is overblown. Realty Income has been consistent with its dividend payments despite market fluctuations. There's still strong demand for income-producing real estate, and Realty Income specializes in that area. Although the payout ratio may seem daunting, it's not unusual for REITs. If you haven't diversified your stock portfolio with companies that own income-generating real estate, Realty Income is a safe and excellent long-term investment for that exposure. If you are looking for a company that pays a solid monthly dividend and offers real estate exposure, Realty Income is a great choice. And that wraps up this video. We really hope you found it valuable. It's clear that certain stocks have gained popularity in recent years because they offer more stability in the market and provide a steady income. Consistent income is something that many people appreciate and prioritize at the moment.